Charts tell half the story. Technical setups may fail, perfect patterns break the wrong way. Price ignores support and resistance. Time to discover what actually drives those candles and indicators you've mastered. Charts reveal the market's footprints. Fundamental analysis shows what created those footprints. Every significant price movement has a catalyst, rarely random, usually rooted in economic reality. Mastering these catalysts gives you an edge that pure technical traders lack. Let me show you a setup I journaled recently. The euro against the US dollar formed what looked like a textbook bull flag. After a strong rally, the price entered a tight, downward-sloping consolidation above the 50 and 200 exponential moving averages, with volume gradually decreasing and the relative strength index holding near 58. When price broke decisively above the flag's upper boundary on strong volume, I entered a long position at 1.0850, placing my stop-loss just below the most recent swing low inside the flag at 1.0835. My initial target was set at 1.0880, aiming for a reasonable move in line with the preceding flagpole. Technically, it looked solid. But within hours, the European Central Bank president made unexpected comments suggesting interest rates would remain lower than markets anticipated. The euro against the United States dollar immediately crashed through my stop-loss. This was not a failure of technical analysis, it was a lesson about market priorities. Looking at the euro against the United States dollar chart, a sharp decline broke through multiple support levels following the European Central Bank announcement. What likely caused this technical breakdown? Trading volume was too light to sustain the uptrend. The moving averages had not yet confirmed the bullish pattern. Lower interest rate expectations reduced demand for euros. The bull flag pattern may have been incorrectly identified from the beginning.
Yes, you're right.
Exactly right. When the European Central Bank signaled lower interest rates than expected, it immediately made the euro less attractive to investors seeking yield. This fundamental shift in supply and demand dynamics overwhelmed the bullish technical pattern. No technical indicator on its own could have predicted this kind of catalyst. So, what exactly is fundamental analysis? It's the study of economic, financial, and other external factors that affect asset prices. While technical analysis studies the price movement itself, fundamental analysis examines the underlying forces that cause those movements. Fundamental analysis focuses on different factors depending on the market. If you trade currencies, you pay most attention to interest rates and central banks. For stocks, it's all about company earnings and growth. And for commodities, prices move with supply and demand. Knowledge check. Match markets with their key drivers. Different markets respond to different fundamental factors. Match each market type with one of its primary price drivers. Trading with only technical analysis is like driving while looking only in the rearview mirror. You can see where you've been, but not what's ahead. Fundamental analysis lets you look through the windshield to spot upcoming bends in the road, giving you time to adjust your strategy accordingly. Time for a quick quiz. You're analyzing a stock that shows a bullish technical pattern. The company is scheduled to release quarterly earnings tomorrow. How might you approach this situation? Research analyst expectations for the earnings. Trade based only on the technical pattern. Focus on other trading opportunities instead. Wait until after earnings before making a trading decision.
Yes, you're right.
Smart approach. Earnings announcements often create significant volatility that can invalidate technical patterns. By waiting until after the announcement, you can see how the market reacts to the fundamental information, then apply your technical analysis to find better entry points with the trend rather than against it. My results improved dramatically when I started integrating fundamental awareness into my technical trading. For example, I now avoid trading around major economic announcements for my day trades. For multi-week positions, I ensure the fundamental outlook aligns with my technical entry points. Technical analysis gives you the what, patterns, levels, and potential entry points. Fundamental analysis gives you the why, the underlying forces driving those patterns. Whether you trade stocks, crypto, or forex, these principles apply across the board. In our next lesson, we'll explore the core principles that make fundamental analysis truly effective. Get ready to see the markets with new eyes. Technical analysis gives you the what, patterns, levels, and potential entry points. Fundamental analysis gives you the why, the underlying forces driving those patterns. Whether you trade stocks, crypto, or forex, these principles apply across the board. In our next lesson, we'll explore the core principles that make fundamental analysis truly effective. Get ready to see the markets with new eyes. Charts reveal the market's footprints. Fundamental analysis shows what created those footprints. Every significant price movement has a catalyst, rarely random, usually rooted in economic reality. Mastering these catalysts gives you an edge that pure technical traders lack. Let me show you a setup I journaled recently. The euro against the US dollar formed what looked like a textbook bull. Three principles that matter. All markets, forex, stocks, crypto, commodities, follow three basic rules of fundamental analysis. Understanding these rules helps you trade more successfully. Principle 1. Every price move has a reason prices never move randomly. Every significant trend, reversal, or breakout has a real-world cause driving it. Our job is to find these causes. Bitcoin surge. Bitcoin jumped from $10,000 to $60,000 between 2020 and 2021. Several factors contributed to this rise. Let's try to identify one of them. Which of the following is a fundamental factor that likely contributed to the surge? Trading volume increasing on exchanges. A perfect technical chart pattern forming Bitcoin's moving averages, crossing in a bullish direction. Major institutions buying Bitcoin as an investment.
Yes, you're right.
Exactly. Major institutions like Tesla, Square, and investment funds buying Bitcoin created real demand. This institutional adoption, along with inflation concerns and payment system integration, drove actual buying that pushed prices higher. The chart pattern reflected this real-world demand. Principle 2. Market reactions are predictable. Markets tend to react in consistent ways to repeated events. That's why it's possible to predict how certain fundamental factors, like interest rate changes or political shocks, will likely affect asset prices. For example, one well-known market pattern is how prices react to data compared to expectations. It's not just the number that matters, but whether it surprises. When results exceed expectations, prices often rise. When they disappoint, prices tend to fall. Unemployment in the United Kingdom drops to 4.1% from last month's 4.3%. However, economists had expected a bigger drop to 3.9%. How is the British pound likely to react to this worse-than-expected result? Rises, because unemployment decreased. Stays flat with no significant move. Falls despite improvement from last month. Follows only its technical chart pattern.
No, the correct answer was
Falls despite improvement from last month. The fact that unemployment improved from last month isn't what moves markets. What matters is whether the actual number beat or missed expectations. When data falls short of forecasts, currency values typically decline, even if the number shows improvement compared to earlier readings. Principle 3. Some factors can't be predicted. Economic reports and elections follow schedules. But wars, natural disasters, and surprise policy changes happen without warning. These unpredictable events often move markets most dramatically. Time for a quick quiz. A pipeline explosion disrupts oil supply in a major region. The market wasn't expecting it. What is the best first step for a trader in this scenario? Reassess exposure and volatility before reacting. Buy more oil stocks immediately. Assume the market will bounce back. Ignore the event and stick to the plan.
Yes, you're right.
Good choice. When an unpredictable shock hits the market, your first move should be to pause and reassess. Sudden events often bring volatility, so reviewing exposure and managing risk gives you clarity before taking action. Acting with information, not emotion, is key. These three principles work together in all markets. Identify what's causing price moves, understand how markets typically react to events, and manage risk for unpredictable events. Knowledge check. Match principles to scenarios. Match each trading scenario with the fundamental principle it best demonstrates. You've now mastered the three core principles of fundamental analysis. 1. Price moves always have reasons. 2. Market reactions follow predictable patterns based on expectations. 3. Some events can't be forecast. In the next lesson, we'll explore exactly what moves Forex, stocks, and commodities. You'll learn which specific fundamental factors to watch for each market you trade. What moves your market? Different assets respond to different fundamental forces. Knowing which factors impact your specific trading instrument helps you focus on the right information at the right time. Markets respond to different types of fundamental forces: macroeconomic, affecting entire economies; microeconomic, affecting specific sectors or companies; and supply-demand factors, affecting availability and consumption. Let's explore what drives each major market. For different assets, some factors matter more than others. Can you guess which fundamental factors have the strongest impact on each market type? The Federal Reserve just increased United States interest rates by 0.25%, higher than the expected 0.15% hike. On the same day, several United States companies reported strong earnings. Which factor is most likely to have a direct impact on the United States dollar against the Japanese yen? Both equally important. The interest rate increase. Neither. Technicals matter more, United States company earnings reports.
Yes, you're right.
Exactly. Interest rate decisions are often the primary driver for currency pairs. When the Federal Reserve raises rates more than expected, the United States dollar becomes more attractive to investors seeking yield. This creates direct buying pressure on the United States dollar against the Japanese yen, as investors buy dollars and sell yen to capture the higher interest rate. For foreign exchange traders, the following factors usually matter most. 1. Interest rate decisions and expectations. 2. Inflation data, which influences future interest rates. 3. Economic growth indicators such as gross domestic product and employment reports. 4. Trade balances and government policy changes. 5. Overall market risk sentiment. It is important to watch the economic calendar for these key events, as they often drive movements in currency values. A company reports quarterly results. Revenue is up 8%, while analysts had expected a 10% increase. Profit margins improved to 42%, which is above the 40% expectation. There was also strong growth in services. The Federal Reserve also cut interest rates today. Which factor is most likely to move the stock price today? Both equally important: overall market sentiment. The mixed earnings results. The Federal Reserve rate cut.
No, the correct answer was
The mixed earnings results. While broader market factors like Fed decisions affect the entire market, they typically don't override company-specific results on earnings day. For individual stocks, company-specific earnings results typically drive the largest price reactions, especially on the actual earnings day. Individual stocks respond most strongly to company-specific factors. Earnings results, revenue growth, profit margins, product launches, and management changes drive the biggest